Hey, I wanted to jump on here and talk about three different types of insurances that you're going to hear when you're involved in a loan transaction. Two of them are good. I guess all three of them are really good. Maybe one of them you don't want, but you probably might have. I don't know. But here they are, and they often get interchanged with each other. They often get confused. Sometimes people use them in the wrong place, and it really kind of muddles things up, right? So I think having a clear understanding of what each one is and does makes the world better, right? We all want to know what's going on, right? So the three types of insurance that I'm talking about are your homeowner's insurance, your hazard insurance, and your mortgage insurance. I guess the fourth one we're going to throw in there is mortgage protection insurance. That's one we hear about too. So homeowner's insurance and hazard insurance, mortgage insurance, and mortgage protection insurance. I guess it's really three because the first two are really the same thing. When people mention hazard insurance or homeowner's insurance, they're really talking about insurance for just the property itself. It's insurance on the home. It's your fire insurance. It's what protects the home if it gets vandalized or a fire starts or anything like that, right? And so on a homeowner's policy or a hazard insurance policy, you're going to talk about coverages for the home and all of your stuff in the home, right? The lender wants to make sure that you have homeowner's insurance on the property because if the house burns up, the lender wants to get paid, right? They want to make sure there's insurance on there to rebuild the home or pay off the loan or anything like that, right? So homeowner's insurance and hazard insurance are often used interchangeably, but they mean the same thing in this scenario. Same thing for protecting the home itself. Now, mortgage insurance is different than that. It's not protection for your home or anything like that, and it's not an insurance policy to protect you. Mortgage insurance is a policy to protect the lender. And the reason that you have mortgage insurance on a loan is because you don't have enough equity in the loan or in the home to protect the lender, meaning you don't have 20% to put down. That's the general guideline. So if you're putting down less than 20% when you buy a house, your lender is going to take out a mortgage insurance policy to protect the mortgage company, right? The mortgage insurance, sure, we don't want it. We don't want to pay for a policy that protects somebody else. But the beautiful thing about mortgage insurance is it lets you buy a house without having 20% down. So there are programs that let people buy a house with no money down, right? And the lender takes on a big risk. And in exchange for that, the lender says, you're going to pay for an insurance policy that pays out the lender if you ever default on the loan, right? So mortgage insurance protects the lender. It doesn't protect you. It doesn't protect your home. It doesn't protect the mortgage and pay it off if anything happens to you or anything like that. Mortgage insurance protects the lender, and you pay for that until you have the 20% equity in your home. Now, the last one, fourth or third, or however you want to call it, is mortgage protection insurance. Now, this one I'm going to attribute to marketers out there with a great flair for sending something that sounds really important and great and cool and kind of masking it. Mortgage and protection insurance is really just life insurance. That's it. There's nothing magical about it. It's life insurance that's really earmarked or tagged by you to pay off the mortgage if something happens to you. But there's no special magic insurance that's just designed to pay off the mortgage if you pass away. It's just life insurance. That's all it is, right? So mortgage protection insurance is life insurance. And if you have a life insurance policy on your husband or your wife and either one pass away, you get that money. You can do whatever you want with it. But in your financial plan, in your budgeting, in your estate planning, whatever it is that you're doing, you can earmark that and say, well, if one of us passes away, the best thing to do with this money is pay off these debts and pay off the loan and set money aside for Junior to go to college and all that kind of stuff, right? So mortgage insurance is just life insurance. So I hope that clarifies some things. Hazard insurance and home insurance are used interchangeably. That's insurance on the house. Mortgage insurance is insurance for the lender, and you have that if you don't have 20% equity in the home. And then mortgage protection insurance is just a life insurance policy that pays out if one of you dies, and you can use that money to pay off your mortgage. That's why they call it mortgage protection insurance. So anyway, I hope that clarifies. If you have any other questions about insurances or whatnot, obviously you know where to get in touch with us. We'd love to help you out, and we just like to make sure that you understand what's going on all fronts. So hit us up if you have any questions. Thanks a lot.